Hey everyone, this is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in today's video, I'll be taking a deep dive into the put debit spread option trading strategy. And so this is a bearish option buying strategy. And if you've seen my other YouTube videos, for example, or some of my SKILLSHARE courses, then you'll know that pretty much 100% of what I do is strictly option selling. And there are a variety of reasons as to why I do that, but that does not mean there can't be a time and place to also be buying options as well. And I will be covering those particular situations in which you should be selling options as opposed to buying options in future videos. So in this video today, I'll just be covering the put debit spread strategy and giving you lots of detailed examples so that by the end of this video, you'll know exactly how it works. And if this stuff sounds interesting to you, then please do me a favor and hit the like button on this video and subscribe to my channel. I would greatly appreciate it. And quickly before we get started here, if you would like to take some in-depth classes on options trading, and stock market investing, then check out my courses on SKILLSHARE. I've been teaching on that platform for well over a year at this point, and in case you aren't aware, SKILLSHARE is a lot like YouTube, except the content on that platform is geared solely towards the purpose of education in the form of online classes. And in my courses, you will see a lot of the detailed research and analysis that I have done using real stock market data with spreadsheets, graphs, and even computer programs that I have written to help simulate and prove the concepts that I am teaching. And I have dropped some links to some of the more introductory courses of mine in the description of this video below. Now, you will need a premium membership with the SKILLSHARE platform if you do want to watch my courses, but if you do sign up for that membership using the links provided in the description of this video, you'll get an absolutely free 2-week trial. And during that time, you can watch all my courses on SKILLSHARE absolutely for free. And then once your trial is over, it will only cost you a few dollars a month to maintain your membership, and you'll gain access to all the future courses that I have planned going forward, in addition to all the other classes that are on SKILLSHARE too. And if you decide it's not for you, no worries, you can cancel before your trial is over and you won't lose a dime. But again, if you are interested, then check out those links below and join the thousands of other students that have already taken my classes. And so with that being said, we're going to jump over to my trading platform now and we'll get things started. Okay, welcome to my ThinkOrSwim trading platform here, and what you're looking at is a 1-year price action chart of the company Disney. And so this will be the stock that I'm going to use to demonstrate how to put on a put debit spread strategy. And so like I said earlier, the put debit spread is a bearish strategy. And so the reason why I chose Disney in this case is because for the past few months, Disney has done pretty much nothing but just go straight up. It's currently at basically all-time highs, even though a lot of their parks are either closed or still at minimum capacity due to COVID. Additionally, movie theaters are still mostly shut down. So it is a bit hard for me to wrap my head around why Disney is at all-time highs, when besides Disney Plus, I would imagine that a lot of their other business is not doing as well prior to COVID. Of course, that is just my opinion. I'm just explaining why I am bearish on Disney right now. So that's why using a put debit spread could be a good strategy to use on this particular stock. And so the put debit spread is going to be comprised of 2 main components. We're going to be both buying a put option and also selling a put option at the same time. Those are the 2 pieces. And just as a side note here, if you have seen my other YouTube video covering the put credit spread, then you should find the put debit spread here very similar, except it's going to basically be the opposite of the put credit spread. And that's because the put debit spread here that I'll be showing you in a second is a bearish option buying strategy, and the put credit spread is a bullish option selling strategy. So like I said, they're just opposites of each other. So let's come over to the trade tab now and I'll show you how this works. So this is the option chain for Disney, and let's take a look at the April expiration cycle. On the left hand side, as usual, these are all the call options. On the right hand side, these are all the put options, and then down the middle here, these are all the different strike prices. And all these contracts expire on April 16th in 34 days from today. Now there is no one way to put on a put debit spread strategy. You obviously have a lot of different strikes you can choose from, and you have the freedom to structure your put debit spread based on these strikes. But if you do want to give yourself a pretty decent chance at making money on this kind of a trade, then what I recommend you do is buy a put option that is slightly in the money. So for example, this 200 strike put option, and that's because with Disney currently trading at 197, then the put option with a 200 strike is just slightly in the money at the moment. You could also choose the 210 strike or the 220 strike, But just note that the further in the money you go, the more money you'll have to pay to put on this position. So there is a balance between giving yourself a decent shot at making a profit on the trade and also not having to pay a lot of money to put on the trade in the first place. So this 200 strike put option, this is the contract that we're going to buy, and then at the same time I'm also going to sell this 190 strike put option. So let me go ahead and set up this order so you know how it looks. So I'm going to right click on the 200 strike put option and go to buy and then go to vertical, and that's because debit spreads as well as credit spreads are also just referred to as vertical spreads. So I'm going to buy a vertical here, and that brings up the order, and so you can see we're going to buy one contract, April expiration, put option with a 200 strike, and then at the same time we're going to sell one contract, same expiration, and this put option is going to have the 190 strike. And so now if we come over here and look at the debit, this is the amount of money you're going to have to pay up front to put on this position. So right now it's quoted as $4.60, but just keep in mind these numbers are going to be quoted on a per share basis. And since these option contracts are tied to 100 shares per contract, you have to multiply this number by 100. So in reality, the amount of capital you have to put up to put on this position is $460. And just to give you some added clarity around this, the reason why you have to pay money for this kind of position is because the option we're buying, the 200 strike put option, this option has a strike a lot closer to where Disney is currently trading. And options with strikes closer to where the stock is trading are always going to be worth more than options with strikes further away. So that's why the 200 strike put option is trading for almost $1,000, and the 190 strike put option is only trading for a little over $500. And so because we're paying for an option that is worth more than the option we're also selling, that's why the overall result here is we still have to pay money to get into this position. But obviously this put debit spread here is a lot cheaper than just buying this 200 strike put option by itself, right? $1,000 for just the 200 strike put option versus only $460 for this put debit spread. So using these spreads is definitely a way to reduce the capital requirements to get into a position. So now I'm going to walk you through a few different scenarios so you can see how this kind of strategy is going to play out. And let's start first with the best case scenario, right? In this case, I am definitely bearish on Disney, so I want this stock to fall pretty significantly by the expiration date here. And so let's say I am correct, and by April 16th, Disney falls from 197 down to maybe 185. So the stock would be well below both of my put strikes here. And so what is that going to mean for this put debit spread strategy? Well, looking first at the option we sold, this 190 strike put option, consider this option from the buyer's perspective. Buying a put option gives you the right to sell 100 shares of Disney in this case at the strike price. And so if in our example here Disney is at 185 by the expiration date, then this put option is going to be in the money, which means the buyer of this contract is going to use the put option. And so the person they're going to sell those 100 shares of Disney to at a price of 190 would be me in this case, the option seller. When you sell a put option, you as the seller are now obligated to buy 100 shares of Disney at the strike price if by the expiration date Disney is below the strike price. Now if I had only sold this put option and did nothing else, if I did not also buy this 200 strike put option, then this position would not bode well for me. Because if I have to buy 100 shares of Disney at a price of 190, and by the expiration date Disney is at only 185, then clearly I'm forced to buy shares of this stock at a much higher price than where it's currently trading, and that's not good. But because I did also buy this 200 strike put option, now as the buyer of this contract, I have the right to sell my 100 shares of Disney that I bought at 190 at a higher price of 200. And so this particular combination of put options here is what makes this strategy a bearish strategy. Because if Disney falls significantly, I can buy shares at a low price and then sell them at a much higher price and make the difference as profit. So if I did buy 100 shares of Disney at 190 and sold them at 200, that's a profit of $10 per share. Times the 100 shares I'm dealing with, that's an overall profit of $1,000. But now you also have to factor in the $460 that you paid to get into this position in the first place. So if you made $1,000 trading the stock, but you spent $460 for this position in the first place, then the overall net result is you still walk away with a $540 profit. And that is the most amount of money you can make on this position. Because no matter how far Disney falls in price, you will only ever be able to buy shares at 190 and sell them at 200. So that is the best case scenario. The next scenario I'll walk you through is what happens if Disney ends up somewhere in between these strikes by the expiration date. So let's say I was only somewhat directionally correct on my assumption on Disney, and by April 16th, Disney fell from 197 down to 196. So a very marginal drop in price. What happens in this case? Well, if Disney is at 196, then the 190 strike put option is still out of the money. The strike would still be below the trading price of Disney, and therefore this option is useless and it just disappears. So that just leaves the 200 strike put option that I bought. This option would still be in the money and is therefore useful, so I could sell 100 shares of Disney at a price of 200. And if I currently don't have any shares of Disney in my portfolio, then what I can do is go out into the market and buy 100 shares at the current price, in our example of 196. And so if I bought those shares at 196 and then I turn around and sold them using my put option here at a price of 200, that would be a profit of $4 per share. Again, times 100 shares, that's an overall profit of $400. But I still had to pay $460 to put on this position. So if I made $400 trading the stock, but I had to pay $460 for these options, then in the end, I actually walk away with a $60 loss. So when you are using these debit spread strategies, when you are paying money for an option position, you do need a pretty significant move in the stock price to actually make a profit. And that's because you have to overcome the amount of money you paid to put on the position in the first place. In order for this position to be profitable by the expiration date, I need to make more than $460 from trading the stock to compensate the $460 I paid for the options. So that would mean I would need at least, at minimum, Disney to be trading below $195.40 by the expiration date to make at least $1 on the trade, right? Because for example, and I'll pull up the calculator here so you can see this more clearly, if Disney ends up instead at $195.39 by the expiration date, then taking 200 minus 195.39, that is my overall profit on a per share basis. I make $4.61 per share times 100 shares. That's an overall profit of $461. Then subtracting the $460 I paid for this position, that leaves me with an overall profit of only $1. So like I said, you do need the stock to move somewhat significantly to actually make a profit on these kinds of positions. And this is one of the main reasons why I prefer to be selling options, because you can actually be completely directionally wrong and still walk away with a profit. But instead, with these debit spreads, you have to be directionally correct to actually make a profit. So your chance of success, your chance of making a profit, is definitely lower than if you were strictly selling options. And the final case I'll walk you through here is the worst case scenario, and that would be if you are indeed directionally wrong in your assumption here and Disney actually rallies by the expiration date. So if by April 16th, Disney is all the way at, let's say, $205 per share, then both of these put options would now be out of the money, and therefore they would both be useless and would just disappear. And along with that, so would the money you paid for that position. If both of these options expire worthless, then you lose the full $460. So this is also the maximum amount of money you could lose on this kind of position. And so lastly here, before wrapping this video up, just like all my other YouTube videos explaining different option trading strategies, I do want to touch on the overall probabilities of making a profit with this kind of position. So I want to direct your attention to these percentages right here. These are the different probabilities of the corresponding options expiring in the money by the expiration date. So for example, looking at the 200 strike put option, the chance that this option expires in the money, which is the same thing as the chance that Disney finishes below 200 by April 16th, is right around 57%. Now, as I showed you earlier, if you want to make a profit on this trade at least $1, you need Disney to fall to around $195 at minimum. I know that the actual true minimum is $195.39, but just rounding down, 195 flat is very close to that. And so if you look at the chance that this option expires in the money, and again, that's the same thing as the probability of Disney finishing below 195 by the expiration date, there's only about a 48% chance of that happening, which means there's a 52% chance of that not happening, a 52% chance that Disney actually finishes above 195. And therefore, you would either just barely squeak out a profit or you would actually lose money. And so only a 48% chance of just barely squeaking out a profit is not that great. Now, if you did want to give yourself a higher chance of making a profit on the trade, then like I said at the beginning of this video, you could also buy an option that is further in the money. So instead of buying the 200 strike put, I could now buy the 210 strike put and then also sell the 200 strike put option just to keep the strikes $10 wide still. But there is always going to be a give and take with this kind of thing. If you do it this way, now you're going to pay over $600, I should say almost $700 to put on this kind of position. So now that means by the expiration date, you need to make more than $673 by trading the stock to overcome the amount of money you have to pay to put on this position. And so moreover, this also means your maximum profit on the trade is also a lot smaller, because the most you can make by trading the stock in this case is still $1,000. You buy shares at 200, you sell them at 210, that's a $1,000 profit, minus now the 673 bucks you had to pay for this position. That leaves you with an overall profit of $327. That is the most amount of money you can make on this position, which is obviously a lot smaller. You have given yourself a higher chance of profit. You basically just need Disney to end up below 203 bucks per share by the expiration date to squeak out some sort of profit. So just to get an estimate, looking at the probability of this option expiring in the money, this is the 200 strike put option, it's around 57%. So the chance that Disney ends up below 203, somewhere in between these two strikes, just kind of eyeballing it, I would say there's around a 62% chance of that happening. So that definitely would put the odds much more in your favor. But just keep in mind all the give and takes that comes with doing this. And so that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you've got questions in the comment section below. And I'm also curious to know what kinds of videos you guys would want to see from me going forward. I definitely have my own list of topics that I will be covering, but if you have certain topics in mind as well, then also let me know in the comment section below. And don't forget, if you want to take some in-depth classes on options trading, and stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And lastly, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel, and make sure those notifications are turned on. I'll be dropping new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.